Greetings, market rebels. Welcome to this week's macro measure. It's Sunday, February. It's a little bit after 11:30 a.m. here on the East Coast, and I'm start moving along here with another best efforts type of production. Here's our trusty disclaimer. Here is our trusty intellectual property rights notice, and then here is this week's main theme, which again really remains point counterpoint, because that's just the way everything's coming back if you look at it objectively, in my opinion. Excuse me. So I'm kept it really brief because I think you should set your playback speed to as close to 2x as possible. I'm still in the midst of an office refurb, made a lot of progress, but still have a lot of work left to do. Luckily, the heavy lifting was done by a friend who did a really great job on getting things recolored, etc. But I think the charts have to do the talking this week, and we'll just balance them out against our tabs hodgepodge. A lot of things I can share, but I think we'll try to talk about where we are in the grand scheme. We'll try to, and other lesser degrees, and then we'll try to convey that really I think you got to raise your DEFCON, even though the charts look pretty good. In some cases, really good, maybe a little too good. But I think the price action still looks really promising. And so there's long-term potential, meaning, many months and on out from here that we could still see this rally continue. But there are some rarities and extremes popping up everywhere. So I think I put a note out about that. We talked about it at cocktail hour this past week. So doesn't mean you start shorting at all. I still think you go with the charts, which is basically trading what we see, just being objective. You can see who's been in control. It's been very clear who's been in control of the market almost every week now for many months on end. Not quite every week, but since I think sometime in October, you've seen, essentially bullish control of the market week in, week out. The early macro hype, as we've noted a few times, is a buy, and it's really been the case so far. And a lot of people would have said this is crazy a while ago. They maybe have been right, but look where we are now. And so there was a time at Market Rebellion where there was a disagreement in terms of should you provide forecasts, or forecasts really what technical analysis is all about. And I've been on the other side of that. Forecasts are fine. I just find that forecasts can actually really hinder the performance, in my opinion, of a lot of people. A lot of people buy into a forecast so, I guess, strongly, and then they end up not being willing to adjust. And I think the biggest key to trading is being willing to adjust, and doing so near the right times and in the right ways. So that's where I come down on that. So I still remain in that camp. I don't think I'll ever leave that camp, but you never know. EPS reactions have been extreme. Let's just note that. When you see that, you don't normally see it to the extreme that we have been, right? There's been several of those. That's not a normal thing. It sort of tells you you're in a rare time. And I would just end on, let the good times roll, but you should also be rolling during the good times. And that's been my thing for the last week or two, where I just want everyone not to get lulled into a false sense of security and start really going at it with your discipline, right? And hopefully, if folks have been doing that, it's worked for them. But I think that's one of the great ways psychologically that you can get involved in the market, stay involved in the market, and feel like you're doing something to be prudent, and it doesn't make you feel like you've got max risk at all times. And that's really, I think, liberating in the long run. So on that note, I'm going to briefly stop the share, and then we'll get right into it. I'm going to try to get up my charting hodgepodge. I'm sorry, tabs hodgepodge. My bad. And let's see if I can find this before I bring this back up. Should be on a browser I have set aside out of the many browser windows I've got open, unfortunately. But one of the first things I want to make the point about, if it lets me share the right screen number 3, share. One of the first things I want to bring up really is that, we've been talking, well, not just us, but a lot of people have been talking about, right, the kind of issues that are cropping up with, for me, been a lack of sector participation of sectors I think are important. There's been uh, kind of like an ignoring of the fact that the dollar and yields are trying to sort of work their way a little bit higher. They're not anywhere near where they were at the highs, so I get that it's kind of being discounted. But and I get, given the Fed speak that's out there, why it's also being discounted. But they are kind of hanging in there to this point, which I think is a little bit concerning. Uh, but there's other things, right? Just a lot of stocks not really participating. The extremely narrow leadership, the degree of that leadership, right? How extended that is. But when you look at it, I think if you look at it objectively right now, and this is just one of those screens that I like to bring up, that is, I think it might be, nope, that is not it. This is where I'm at. That we'll come back to that one. It's not that one. Not that one. Come on. I just set this thing up and I wonder if I have so much trouble with my getting my bread screens to come up. I wonder if it moved on me. I feel like it did move on me. Sorry about this. There's a good bread screen that I've got layout. There it is. I must have skipped right over it. My bad. Sorry about that, gang. Anyway, for all the criticisms on that, right? And I'm just going to scrunch these down. But for all the criticisms, if you look, I'm actually looking at the Mag 7 here as a package, but just remember that these breadth measures are, they're not fluctuating based on the symbol. So I'll try to just emphasize that, again, I'm not going into details here, but there's the advanced decline line cumulative average, right? It's been improving in the market. The number of stocks above certain SMAs, those have continued to tail off a little bit, but they're not cratering. Okay, so that's something to keep in mind. Here's your just cumulative volume index, right? That's sort of hanging in there as well off the highs, but hanging in there. And then here's an important McClellan oscillator, the last week plus, that's been improving. And it's kind of held the McClellan summation index up as well, slightly, where it's really not on its way down to crating. The trend is still down. So I'm not suddenly saying everything's bullish. All I'm saying is that there have been sort of slight improvements, probably on balance, from where we were a few weeks ago. So it's not as if things are just in this way, in these simple breadth indicators that we've looked at. It's not as though things are worsening in a big way in every which way that you look at it. Some things certainly are, but so I'm not really as concerned in saying, well, this just keeps building into a compound divergence. And there are some things that are like that, but I just mean on these, it's not there. So usually, right, you won't really want this to be working in with you. And right now it's sort of a little bit more mixed to positive, slightly relative to where it was. That's all I'm getting at. So having said that, let's look at the tabs now, because that's what I wanted to set the stage for, is that things are just not getting that bad yet. Now we can look at a couple more up close. So this is right through elite, and I'm jumping to this because we'll do it in order. But here's the number of stocks above the 20-day, and you can see, right, that started to improve last week. So it was, overall worsening, had rolled over, but they came back for them. If we look at the stocks above the 50%, of stocks above the 50, it also has started to rise again. Again, is it a problem? Sort of, yeah, but it's not the end of the world right now. It's not getting worse and worse and worse. And percent of stocks above the 100 started to improve late in the week. What about percent of stocks above the 200? It did the same as the 100, right? So do you get much better than this? You can get better than this. Is it up towards the highs? Yes. But look, there's nothing that says they just can't, push a little bit further. So I don't think on some of these basic views on various breadth measures that things are that atrocious. Had things continued to really, really tail off, I think, to me, like, that would make it more worrisome. Usually, you don't want to see such narrow leadership, and usually you don't want to see things which we'll talk about in the sector situation, like transports and so on, being left behind, or there being such an incredible stretch between certain stocks and other stocks. But let's if I can't get that tab quickly, we will come back to that. So let me see if this is it, and if this one down here is it, and the final ones I'm trying are these two. And if it's not at the bottom, then I'm not going to bother with it. Nope, I'll have to come back and I will try to find that what's going on there, but that is not what I was looking for. So we'll come back to that. But let me get into these tabs again. So in terms of these tabs, we'll move back to then go forward. So here's the AAII recent survey. You can see it kind of held steady, a little drop off in bearishness, a little bit more neutral, but still getting up there. Not extreme, right? We've seen higher readings. A year ago, it was 52.9 right there. And so you can certainly get a little bit higher because we'll see, but it's hanging in there bullishly right now. We are in extreme greed right now. So again, that's why you've got the little DEFCON note there that we reached an extreme, could persist. Just be ready, kind of right in line with what I wrote as a little note in UOA Pro, what I wrote and posted in Rebel Pit Elite, and then what we covered briefly in Cocktail. I think it's just time to really be on your toes. Doesn't mean you start shorting the market. We already took a look at the percentage of stocks above various SMAs. Now I'm just going to hit you with the tabs hodgepodge really quickly, and just so you can see some of the stuff that's out there. So volatility skew, I think what they're listing here is, I'm not sure exactly. There's one that I've got that's, 25 delta call ATM ratio. So they're comparing the volatility at the 25 delta call versus the at the money to show that skew has gotten to the highest levels in 20 years. So while put volatility skew is at a low or near the lows. So those are extremes, right? That's basically telling a contrarian type thing. So these are some of the rarities and extremes that I mentioned in the notes. However, right, we've noted that financial conditions are as easy as they have been in a few years. And these buybacks are starting to come online in a significant way. All-time highs, no, but look, those are pretty hefty numbers, right, that will be there supporting the market. Remember that under the surface of this market, right, there's all kinds of issues with all the shenanigans the government, economists, and I guess government statisticians are playing with the employment and inflation. It's really becoming egregious. These, I don't know Liz Ann Saunders to be a political operator. Maybe I'm wrong, but I don't recall her ever sticking her neck out politically. I think she's pretty much down the middle in terms of that stuff, and keeps it real in terms of what she's seeing. And there you go, right? So full-time employment is just absolutely plunging, regardless of what this, that, or the other one claims, according to her. Okay, according to her, there's price action. There's price action that occurred during the 1999 dot-com bubble and after the global financial crisis, right? So you could take a look at what WinSmart CFA is putting out. So some of the stuff that we've been saying, it feels like the 90s. That's because I guess it does. It feels like the 90s based on some of this, the madness that's occurring within the markets here and there. Biggest divergence for S&P 500 and NYSE breadth in, what's that, 47 years, roughly, 46 years. So keep that in mind, right? That's something right there, very rare, right? You don't see that every couple of days, right? It's something you only see every several decades. The current market conditions cluster, right? Various market conditions is among the worst 0.1 instances in history. So typically followed by abrupt market losses of 10 to 30% over the next 6 to 10 weeks. Take that for what it's worth, but I did not really know that, but I can't vouch for this. This is according to I guess Hussman Funds, so that's them putting that out there. But it doesn't surprise me because of what I've been seeing myself uh, in various ways. So to be that extreme, maybe it is a little bit more than I would have expected, but still, it's very extreme. According to these guys, insiders are dumping big. You could see the spike from just a few months ago. Look at the selling that's going on. So I wouldn't discount that as chopped liver. Credit card and auto loan delinquencies are spiking. Okay, this is something Ryan and I have been trying to convey in webinars consistently. Um, then there's this one here uh, about, you may want to read this one, but this is sort of saying that there's a lot of what you'd expect going on, and this is going to hit the fan. Just another one of those kind of articles. Some of these things like this, though, kind of make you feel as though there's some validity to things like that, right? Stunning collapse in credit card debt change as average APR hits new all-time high. So the APRs are at an all-time high, and people are already behind, and people's balances have already skyrocketed, and so they're kind of getting tapped out even on credit. So will it matter? I think so ultimately, but in the short run, I'm not so sure. But this is the whole point of these, is to have you appreciate what a unique situation we're in, at least the way that I see it, where you've got the chance, based on so many things, of really storming higher. And at the same time, things are just kind of coming apart at the seams. Like median home prices are now contracting at a rate that's never been seen since 1964. That's a little bit of data, so that's some rough stuff. The greatest real estate crisis since the financial office property troubles spread to Europe. So the office vacancies are pretty much right throughout the West at this point, due to whatever you want to call it, telecommuting, tele this, tele that, and the reluctance of people to want to go back and work in an office. So I guess for various reasons. Here's the record credit card balances, according to CNBC, who I guess is the soft landing cheerleaders. Samantha LeDuc, I follow her. I think she puts out some pretty good stuff. But you can see that it's very 1999-esque according to her. So it's not just Greg and Ryan and myself saying that, hey, this is starting to feel a lot like it did then. And it was great trading. It was great to embrace it. But again, don't get caught. And I think one of the big secrets, that's not really a secret, is just to be an aggressive roller. I keep reiterating that because I hate, over the years, I've talked to hundreds of people that just, they don't even think about taking any of their chips off the table. They leave it all at risk all the time. There's no need to do that. Absolutely no need to do that, because you could just be in a 35 or 40 delta call instead of being in 85 delta, 90 delta, if things have worked out in your favor, or worse, equity, and then you don't do anything when you know that there's all these extremes popping up. It's really only through a lack of, I think, knowledge and confidence, right, that folks, just a lack of familiarity, really, right, that folks let this happen to themselves needlessly, and they don't need to. They've got, according to Markets and Mayhem, they've got a lot of people in here, right? Asset managers are in, and they're in big. Okay, 100th percentile. So it doesn't get bigger than that. Here's just one of those anecdotal things that you may have seen this week. In NVIDIA worth as much as the entire Chinese stock market. And then hedge funds are leveraged up, the highest they've been in 5 years. Okay, so they're often, and they're also short as well, short in things like IWM, which is starting to look really good on the charts again. According to Hussman, once again, your equity risk premium is now worse than it was in 99 and in 29. So take that for what it's worth. Again, you could just check out Hussman if you want to read it, the whole thing, click on it. Here's the extreme of MAG 6, they're calling it now, call option activity. Here's the 2 to 4 week forward window skews towards negative returns. So that's kind of coming in line with what I'm about to share, which is that you get through the NVIDIA earnings, It still looks like it has great upside to me, but that might be right. That might be them ringing the bell, but without really ringing the bell. Just a thought. I'm looking at it and saying that there needs to be a cooling off if they really do find a way to kind of tread water and then jam even further on Nvidia. Not that we crash. It's just that you probably should see some sort of a corrective activity that's more than 15 minutes long. So you've got the most shorts since August, according to, with market making new all-time highs. The penny stock is doing its trading is doing its thing again. In some ways, right, it's even outclassing what we saw in 21, which was just 20 and 21, which was utterly remarkable, I thought at the time. But again, look what's happened since. Here's financial conditions continue to ease, which, you know, you think about what's going on, and there's a lot of people, a lot of important people taking advantage of that, and a lot of important people in the government pulling levers to make everything look wonderful. And here's another reason, right? If you wanted to say, well, maybe we should be looking at IWM, which would be a big deal. I think if IWM gets going, that would really be a surprise, even though the charts look good. I just mean thinking about it, like how are these small companies, which are really in some ways not set up for this kind of a higher rate environment. They're really not. There's a lot of supposedly zombie companies in the Russell 2000 that are just being kept alive by, I guess, life support, according to some. And but look, they represent value here. So I don't know. Maybe there's the S&P comes in a little bit while you get a little pop in IWM, kind of put the relationship a little bit, make it a little less extreme than it is right now. But I think IWM moving up would clearly be a really good sign for people that like to see that participate, and to kind of say that there really is a new bull market here, which there could be, despite right all the problems that people keep raising. And I think ourselves included, we're also saying, yeah, there are some problems here. Again, trade what's in front of you, trade what you see. Know about all this for your risk management, right? And to not be caught off guard. That's the big reason why I think we do this, is to kind of continue to stay dialed into this market, any market really, and appreciate where you are in terms of not just the price level and the potential, but the underlying risk that seems to keep growing. So this is relatively rare, right? 70 days, trading days without a 2% pullback. That's pretty good. There's another one in here. Right? You don't see that too often through all the years. There's more than a handful, a few handfuls of times where this has been the case, right? But it's not that common. It's relatively uncommon, as you can see. The other one is tech. The concentration in tech now is 1/3. It's the most since the tech bubble, the .com bubble in 2000. Right. So that just kind of gives you an idea on concentration. The top 5 stocks are trading at 3.4 times the market cap of the entire Russell 2000. So price to sales is 7.7. So you can see how extreme these are really over the last 20 years, where you are right now. This maybe is courtesy of the echo and the original injection of whatever $7 to $11 trillion are the estimates I've seen into the market a few years ago in the COVID madness. So if you remove tech, the rest of the S&P 500 trading at all-time lows against the tech index. Equal weight underperforms, not the best sign. Everyone's talking about this, right? How it's being so narrow, but there was one more that was in here. Okay, so the last time skew was this low, and they're looking at, it looks like 1 month out 25 delta puts minus 1 month out 25 delta calls. The last time it was like this was right before Volmageddon, when things went haywire in 2018. There's one that's not here, and I think that I'll just mention this, and I may be misquoting it, but let me try to do a quick search for Dow 14 weeks. It might be Dow 14 weeks. That kind of sticks out. Yeah, 14 weeks in a row. This is the longest stretch of consecutive gains in the history of the index. So that's from way back, though. Well, that wasn't, I wasn't on latest. Okay. Okay. Yeah. 14 out of 15 weeks of gains. So that's what I was looking for. Where now there was one on this that was, well, I can't find the one that I somehow must have clicked over and gotten rid of. But anyway, I think they said that the last time we had something on par with this was 72. And there's 50 years, right? So just give you an idea. So I think that gives you a little bit of a flavor for what's happening right now. But if we go back to the charts and we go to, I've got a chart. I think that this is the one I've been working. Well, I wanted a really basic one. This is the problem with not being able to name the individual charts and just having a lot of layouts that I really wish I could cover. So this is one of them that I can cover just to kind of give you just a more of a pure price action view. But this is the Mag 7. I'm still calling it that. We'll see if they let Tesla back into the club. I don't know. I guess that's been the problematic one. So get rid of it. But right, we've been talking about the technicals and how promising they look now since really this rally started in the fall. So let me just switch over to a larger view to kind of show that sort of cup and handily type action, and you're getting it. And we said, this is typically a pretty solid pattern, and when it fires, it can be pretty good, and it has been so far. And so you can just see that this projection isn't based on the cup or anything like that. It's just another simple projection. But it shows you really nicely on the weekly where this could carry to. And the way that this thing has shredded through, it paused at the 38.2 extension, kind of paused there around 50, kind of closed there right on a weekly basis at the 61.8. And so it's respected the levels, but it hasn't allowed those levels to really trip it up. And so the next one's going to be 23.82, we'll call it, not too far away. It gets through there, right? Then you're looking at this thing heading up to there, but towards 26.50. These numbers are obviously just, right, they're just a mini basket of numbers, so it doesn't really mean anything. But you get the idea that there's still a lot more room if this were to kind of fulfill the 100% extension destiny. And so far, it's encouraging what's been happening here. I think you have to say that, yeah, that's pretty encouraging. So they really haven't allowed a lot to happen. However, right, there was one that I set up, which of course is eluding me now. So we'll just have to figure out which one it is. There was one of these views that I set up that, no, that is not it. And is it this one? No. This is what's so frustrating. I'm sorry about this, but I know that I've got this somewhere on here. And when I go from one thing to another, everything just gets buried. So it becomes tough to, that is also not it. That is also not it. Well, this one has a comparison, and I'm not sure why I'm struggling to get that one. I might have to go back and see if I can add a comparison onto here. Let me go back to just a daily view with quite a bit of time. And there's the view, but the comparison really, I'm trying to, let me see if it's under here on comparison line. I'll just try to show if come on, edit studies. I'm not sure if it's going to let me. Yep, comparison line should be there, and it's not. I don't know why. There, okay. Apply. And the comparison line will be there. Now, this is clearly, right, not the perfect way to compare these, but I just wanted to point out that how extended this is, and this, let's make sure we know what this is. It's the spiders. So you can see the comparison right now. You may be in the last, let's say, 5 years, and I think it's going to turn out to be true, but this is probably the widest stretch between the market and the Mag 7. So this is becoming very, very extreme, right? Things do not normally get too much greater than where we are now. This is another one in here that's obviously very extreme. There are other ones back further, but we can't fight. The problem that we have right now is that we can't fight against this trend yet. I think it would be, unless some news emerges that will really undermine NVIDIA's EPS reaction potential, or that the reaction's poor, but I think you're 10 days away from that. So right now, right, I've been saying I think they're going to try to string everything until that, at least because it's sort of like the stock of the moment, with the earnings report in a quarter that's been an incredible quarter for EPS reactions. And I just wanted to show that a lot of the lines that I've got, there's SMH, and there's my kind of simple, this is nothing sophisticated, this orange line, kind of like upper part of the channel resistance line. But you can see that that just continues to show. This is why I've been saying, we talked about it last week, that the SMH has more upside potential. And it depends on when it gets there. But we said, I think with it at 198, we were talking and saying, look, this thing's got, can get up to 215, something like that, 217. Depends on how quickly it rises, right? If the slope is a little more moderated, it could take a little bit longer to get up towards that line. It doesn't have to go there naturally, but if it shouldn't do that, it could be even higher. So it all depends on if it goes, and when it does, if the slope is extreme or if it's like this. But that would sort of be my expectation, that they try to do that. And they've kind of worked it beyond the middle part of the channel. So to me, right now, that thing, that looks like it's still trying to work its way higher. Now, if I bring this up, let's just take a look at SMH on RSI. And right now we're at a 75, almost 76 reading on it. So you already know that you're approaching extreme RSI readings. And so this is, again, this gets back to why I continue to harp on just keep rolling, right? Are you making as much money as if you stayed in 90 delta calls? No. But are you banking money that really, if you stay on top of your final roll, they really can't take that much of what you've made back from you, even if things go off the rails in a big way. But just to flash a number at you, we have a 77 reading on the weekly RSI in SMH, right? So that's also a very high reading. A lot of your heavy duty intradays are in the mid 70s right now. So this is a runaway train. That's why I've been calling for like a euphoria spurt or a euphoria burst that sort of puts an exclamation point on this. I don't know if it'll take the NVIDIA. I don't know. It's almost like it's, at this point, I thought about it a while ago, but now I'm thinking maybe it's too easy just to say, yeah, the spike happens on NVIDIA. And that's when you sell, right? That's when you really take your profits, and maybe you're in a very low delta options at that point, maybe like 30 delta, 25 delta, and you cut back on your size and you have a tight stop, because remember, you can always get back in. So I'd rather take the profits, be not so aggressive after there's been this extraordinary move that's in very rare air. And then if I have to, I'd rather get back in with a fresh trade if my 25 or 30 delta calls aren't performing. I'd rather just do that, because I don't want to force it when it gets to that point, because usually that stuff does not sustain. So there's plenty of room, no matter where we go on the charts, there is plenty of room to continue to go. Here is the SPY. There is the simple, classical technical analysis channel, maybe with the only difference being that we're using a geometric chart. We're not using the old arithmetic chart, but in other words, these are percentage jumps rather than what should be on that. Let me double check that. I don't often change that, but you just never know. Yeah, it is using a log scale. So that's where we are now. If you do get here, I'm a kind of that believer in, if you do get above and close above, and hold above there, that middle kind of orange kind of middle line in this upsloping channel that we're in, that you have a pretty good shot at hitting the other side of it. So that's why, if you've been hearing me say, I still think there's upside potential in this market. It's short-term overbought clearly in SPY, 73 on your RSI, your weekly's at 75, but your dailies, your monthly's only at 65. So Could they make it extremely overbought on a monthly basis? Yeah, I mean, I think they could, right? So, what was it back here? Let's see. This one looks like the extreme, right back at that point. That was 80 on a daily. So we're not even quite there yet on that. So they could certainly do that. So that's why, it doesn't really matter what I pull up out of the big four major market ETFs, major index ETFs, but um, even that you could see there's one line there that I've got for the Dow. I'm going to keep that line there because this is a line that I've worked with over time. And sometimes in earlier, I used to bail on these lines and just say, yeah, that line's no longer relevant. And then ultimately the gang would work their way there through movement and different reactions that really were take your breath away moments. The first times I'd seen them, like, how do they do that? But the Dow's trailing behind, but you could just see it's got a lot of potential if it were to get back up there, even if it were to kind of get back up to what was a support line for it, which could now be a resistance line. If I just take this one, kind of cut right underneath a lot of those lows, and I just extend it, like, even that line is a really still a nice move higher. The Qs, we should be talking about those. The Qs are also in a similar boat, and I don't know what happened. Oh, there, I was going to say, I'm pretty sure I had lines on the Qs, but they're in a similar boat. Only they're maybe ahead of the game, right? So it depends on really where you want to work with. What I do is I try to expect it to get to the closest line, and then if it exceeds there, I try to revise the line and then add another one. And this would put it a little bit higher if we were to use those two, kind of like those two highs in that area. But both of them are still a little bit up a little further. The one that I added in this one, so it's got a little bit more potential. But you can see that is probably the one that's out there on the classical charting stuff. But if you look at the projection, like, you can see that still has a lot of upside potential based on just a simple projection of a strong move up, a pullback, and then from there they've got that. I would ballpark it at 466. So what's that come out to? About another not quite 5%. So another 4+% that thing could definitely move up. And again, SMH has potential still to go. You can see that's not quite at the 100. That's 100% projection I'm working off of is at 214. The NVDA being the big dog stock of the moment, that projection still says there's a little more to get up there when those lines show up. So to get to the 100% projection on that would be 761. That's up 40. That's about 5% higher too. And so let's talk about IWM, because that's another one that's really starting to look good. This is clearly not overbought. This is consolidating. Remember, it's a great mover, but it can be a squirrely little player at times. But look, what have they been able to do, right? We had a triangle there. They did the old false breakdown move. This is always a good thing to look for. And as I point out every time, this is why you have to be someone who is willing to use their stops. If you traded a breakdown here and you held it overnight and they start taking it back into the triangle for you, right? You just got to say, like, look, they're reversing this back up right after it failed to break down. And those can often turn into swift moves against you. This one took a little bit of time, but it did intensify as the week wore on. And now they've got it back above all the SMAs. It's consolidated nicely. And right, this looks like a higher low, sort of at mid channel. And I'll just put a little line in there just to kind of highlight that. No big deal, nothing sophisticated, but get the idea. There's a little bit of a line there, sort of at mid channel. And that didn't draw too well. Let me just click this and pull it back for everybody. Kind of gives you a little bit of a line, sort of at mid channel, held there. And So you have the higher low, and you're working on possibly a higher high too. Now, remember, this high was slightly higher than some of these highs that were put in here as well. So they're trying to pull off a trend change, and they snuck in one little, one last real wrinkle there to draw in bears, and they got that below the 50 there, the rising 50 there in gold, and then right, it looked like it was in trouble, and we prepped for it. And part of our idea is prep for maybe a breakdown, and it didn't happen because you just never know. But anyway, you could see, right, the volume was dwindling. This is one thing that can still, I think, be helpful about volume. Volume was dwindling, and you could see the volume, really the volume slingshot maneuver there. So this thing's now picking up volume relative to where it was again. So it looks like there may be a possibility for more there. I've got a bullish idea in on that one as well. That one I think may have triggered, I don't recall. Anyway, if it gets through and they keep the good times rolling, we would expect it to go back and try to challenge that high. But this thing is not overbought, and you have to like these subtle little moves in terms of the price action. Almost a higher high potentially. Remember, there could be a false breakout. These guys know this is a good trader, and there's a lot of sharks operating in that one at times. But if we look at it on a weekly basis, right, you could see that we've been talking about this being a big deal if it can finally break out of this long-term consolidation. This is going on for a couple of years, and that projects much higher if it does. So there's a lot of potential there depending on what you want to look at. And excuse me. So just keep that in mind, because if they really do start to move this thing up, it really could go. It's got to clearly get through there, but that's way down from the all-time high. And this is something that a lot of people that do what we do, looking at market breadth and trying to see if that's helping to confirm what the market major indices are doing. This would be very helpful for that cause. I think a lot of people would get more confidence if they felt that smaller businesses were on good footing, that rates really were coming down. They're coming down in a big way ultimately. And then these guys can continue to borrow at rates, and they can afford to borrow at, and get things really going again. And that could be the case, right? It could be, like I said, you might think a lot of, and I think there's a lot of shenanigans right now, like even beyond the great deal of shenanigans we see all the time with reports and everything being really falsified is the right word, but it can become real later on, right? And so there's a lot of people speculating that the market just anticipates a more business friendly administration, and that's why they're starting to front run at all that change. They want to be early on that, and there could be some truth to that. So I don't know. I mean, that's not something that I can really comment on, but if they start to bring this along, it's going to kind of be another sort of notch in the belt of the bulls, right? Because they will have gotten bears again who've been saying, well, yeah, show me when the IWM, essentially when the small caps are going, and so on and so forth. And so that could be really, right, a big win for them. And it would really, as I said, I think encourage a lot of people to say, hey, this thing might have more legs than I realized. Now, it doesn't remove us from the immediate concerns, which are that you may be just overdone or getting even close to being even more overdone, overly toasted in the near term. I think that's really what you have to be on guard for, is that you just have to navigate, right, when in these, you have to navigate the big picture, but you also have to navigate the short term, and that can be tricky. And so right now, the TNX on a weekly still kind of trying to do something, still kind of threatening to try to move back up. Yields going back up, not what the market would want to see, but probably, right, there's probably some point if they were to move back up that the market really starts to worry about that, and it starts to affect things. If it spikes, which we have seen at times when there's been these big sort of little bit more than a week's time, but you get these kind of big like reversals and go, that's something that would start to probably affect things, right? If yields started climbing back up, let's say to on the 10-year here, 4.5. So maybe that starts to get people worried again, but it hasn't backed off. It's hanging in there, closing near some of the highest levels it has. And let's see if it's the highest close in a few months. It does appear to be the highest close in a few months. So you've got to take that a little bit seriously. Again, I continue to say keep your eye on these and keep your eye on the dollar. And with the VIX where it is, you probably need to start thinking about, yeah, the VIX is like watching paint dry these days. But again, with the Volmageddon thing and people kind of getting a little too frothy, dollar, right, that's sort of threatening a little bit, kind of a nice little corrective pullback. And if they start to go again, right, they will have paused and they'll be breaking through. They made a new high last week or earlier this week on the dollar since the bottom got put in. And now if that starts moving back up again, this is sort of early signs for people positioning maybe that there will be some corrective action. I don't, again, I'm not calling for a crash. Could a crash happen? Certainly. I think if these things spike back up and the way that you've got people poorly positioned right now, and so many people are loaded up and there's a lot of public participation, a lot of the signs that we've seen that precede really bad things in the market are there. But at the same time, I think one could happen. I'm not really expecting a crash. I'm expecting more or less we put some kind of exclamation point on with this sort of euphoria spurt where everybody's sort of astounded by what they just saw because it was some on the road to get there. We were already astounded. And then you're sort of like double secret astounded. If you get to that point, that might be it for this for now. And I just think you probably get some sort of a pullback of the overall move. I don't think you're going to get a crash unless there's something out there. Now, there are European real estate problems, American real estate problems, China real estate problems, probably Japan real estate problems. There's also all kinds of banking issues that are just remain off the radar, but crop up here and there. So yeah, I think you just have to be careful, but just keep trading this trend until it stops. And again, I was talking about on cocktail. I was not trying to say, a 10% move. When I was talking about the 10%, I was really just talking about if I'm a bear, which I'll just bring up a chart on. Let's say we'll bring up something on like the SMH or Qs. But look, excuse me. Let's just finish on this part. VIX getting down towards the lowest levels that it's been for some time, right? So you don't really get too much lower than this too often. You're right near the lowest levels with a 12 handle on it. So just keep that in mind because again, I think you should have your not that you should initiate them, but I think you should have your downside put butterflies. Ryan will cover these for you. I would have those selected, not traded. I would just have them selected that if you want to quickly add a smart little position in case there is a nice pullback that you can. But what I meant by trading, and because people tend to want to short things when they get this extreme, and I get it. I mean, myself included, but you got to do it your way. But what I learned the hard way many times over was that catching the final whoosh lower is hard, right? So there may have been people that thought it was extreme here in SMH, here, and they've been looking for a much bigger payoff than they've gotten, and it just hasn't come. And so you could say, well, this is even more. If I hated it, right? If I hated it here, I have to really hate it here. Or if I hated it here, I had to really hate it there. And now I have to really, really hate it here. That's the way people think. I've had these conversations with people. So the more insane in their mind it becomes, the more they want to short it. All I'm trying to save people from, because I learned it the hard way, is if you want to fight against this, I would just wait for some signs that you're seeing some kind of a potential crack of something. And look how far away from your 10 SMA there in white you are. That's the lowest, smallest one I run in terms of duration. And you're not even close to it. You can't even say that you're, in terms of a support line, you're there. So if you were to crack that support line, I think you've got to fall at least the most aggressive support line I can draw right now. You've got to fall at least, I would say, 3% to really threaten cracking that line. That's all I'm saying is don't fight it, right? If you start picking a fight with something when it's going up, these guys can really chew you up and spit you out. Oh, it's crazy here. You sell it and they just take it up, up, up. And that's a lot of pain. If you sold it here thinking it's double top, they've got it up, up, up. There's a lot of pain. All I'm saying is, right, if you wait for support of some kind to crack, something that's telling you there's a reversal, it could even be a candle if you're big into reversal candles. That's fine. I think they're worth looking at. I incorporate things like that. I'm just not a big fan of all the candlestick patterns. I don't think a lot of them have a real strong predictive value. Some I think are better than others, is what I'm trying to say. And when that matches up with my other stuff that I like to do, that's when I really embrace them more. But if you want to see something kind of crack, that's fine, right? But the good thing about trading, let's say we'll use the close of Thursday as our level. So if we were to close below 199.43, we really wanted to get aggressive. We would say, look, if it's going to close below 199.43, I'm in. It gets there. It looks like it's going to close below it. It closes at 190, let's say 198 and change. We're in, right? Well, that's to me why that's a smart move, is because you may be catching the start of something like this, first of all. But secondly, you now have a really tight stop that if it closes above, you're out on. Here, with it being at an all-time high, you can just randomly pull a percent out, but you don't have any real price action near there to say, yeah, this is a key level. If it gets back above there, I've got to call my short, over and just neutralize my risk there or close it completely. Right. So you don't have anything to trade against that's nearby, unless you're doing some other fibs that are different than mine or something like that. But that's all I'm saying. You're really shorting into the abyss. There's nothing there to really get in the way of the stock. There's no resistance that's going to help you. All you have are probably extensions or other things like that, or projections from different methods. And that's a tough, in my book, that's a tough way to go when you short against something that's incredibly strong and you don't even have any structural overhead resistance that's going to help to keep this thing tamped down, and then have you say, yeah, if it gets through there, I'm willing to say it didn't work. It's just too easy to keep going. And I think when they have a catalyst like NVIDIA, coming up, it would be too easy to keep going. So in a nutshell, to start wrapping things up, in a nutshell right now, you have a market that's overbought. It's frothy. There's no question that this market's frothy. There's no question, though, that there's the NVIDIA catalyst. I'm wondering if that's too easy. There are other earnings, of course, but that's clearly the biggest of the big dogs remaining. A lot of incredible stuff's been priced in. And I think you're probably going to reach a frothy peak sometime relatively soon. And that might be the time, again, to sort of mostly cash out. And then I would say, if you want to trade the reversal, trade it. Just keep yourself on a short leash, because remember, this is a strong trend. You're going, if you go up a little bit further, like I've been saying, you go another 3 to 5% of the upside in the near term. I think you're going to be at a real extreme, and you just got to be extra, super, double secret prudent beyond where we already are at that point. Remember, things can even keep going from there, right? Just because I've got a line up here, it's not as though I'm saying there's no way in hell it gets through my line, right? Maybe on like the second week I ever charted, I would have said something like that because I was so inexperienced. But ever since then, all I'm using this as really is a sort of a logical stopping place. And that I know that these guys are the masters of exceeding things a little bit, running stops out, chasing stops out, and then reversing. Right. So not even that is like going to be to the penny, which is why I don't try to get caught up on precision. Right. We're really looking at using this in a common sense way is what I would rather do, at least the way that I look at it. So know where you are, and that's where you are. And if you look at the big picture, though, that's what I'll do for everybody on. Let's do that on. We know IWM is. We talked about what's happening there, which is very intriguing, and it couldn't matter a lot for the market. But just remember that if we go a little bit bigger picture here on SPY, it is overdone. Remember, I told you 75 on your weekly RSI, so that's up there. But here's your kind of weekly big picture pattern, and you could really be even further than this right now, right? So with a cup and handle, some people are going to say use anywhere between 70 to 100% the height of the cup. You probably are going to have to call this the height of the cup right here. That's at about 460 to round it off. This is going to be a low of about, we'll call it 350. So you're looking at 110 points beyond here, right? So this is one way to project it. Some people take it from where the breakout of the handle happens. You can do either one. I'm just going to do one of the older ways. And then if I add 110 to 460, that puts me at 570, right? So that puts me somewhere up here, just using a projection of 100%. If I only do $70 through there, or 70, call it 75, then I'm going to be at I'll be at 530, right? Those are sort of just simple pattern projections. Again, if you want to use this, your math's going to be the same. Just pick the breakout level of 440 instead of a breakout level of 460. So that's just one way to do it. Another way you could do this is to just, which I prefer, then I like where the patterns and just simple sort of extensions also kind of overlap each other. If anyone's been following what I like to do for a long time, you'll always hear me talk about it. I like to use a lot of different techniques and kind of overlay things and see if there's a cluster. That's what I'm really going for, is to say that, do all the things sort of say bullish, how bullish. There's other things I do that I don't talk about because it's just too much stuff, and my videos are already ridiculously long without even trying to design them that way, which I wish I could get around 459, kind of reduce them, but for some reason that's just the way it happens every week. I think it's just built into me personally. I'll take full responsibility for that. 409.21. And so we're already through, right, the 100% on that. So our next one is 510. That could be a short-term stopping point. But again, we were talking about 530 with another type of projection from the cup and handle. That puts you at the 161.8, puts you near 537. So there's that, and then the big one, and we've talked about that 261.8, 61, 615.48 on SPYs. We talked about that way, way, way back in the fall, when we were, because of the sharp reversal and the rates discussion, we were saying, look at the uptrend in the market. Don't discount new all-time highs. Don't discount they could take this really way up there. And you have to be objective that way, I think. But so we were saying this is possible despite everything, but we weren't predicting it. I don't want to claim as though we threw out these targets. So I don't want anyone to think that. All I'm saying is we try to keep an open mind, and that was part of the open-minded discussion. And I don't think that happens. I don't think that happens in the next couple of months. But ultimately, with the way that the powers that be are trying to rig things, could I see that happening if a lot of things fall into place and rates really come down? Over late spring into the fall, and then maybe they drop them even more because they find out they have to. Yeah, usually when they're panic reducing rates, though, that's not good for the market a year later. But right, who knows? Like it doesn't mean it has to be that way. But if they did do that, I could see things really going even more turbo. So we shall see. I think you have to, in the wrap up would just be, you've got to stick with where you've been. Where we left off last week is really where you have to stay at. And that is, I would just get your DEFCON level up to wherever you are, just take it up just to be ready. Maybe not this week, but maybe next week. Who knows? Maybe this week, maybe some news changes things. But I think you you've got to keep, and this should be let the good times roll, but you should really just keep rolling. I think this is the secret. It's not a secret. It's just take the money, bank some of it, stay in the trade, and then as long as it keeps performing, stick with it and do it all over again. Do it all over again. Instead, and that way, on the last roll, you might get beat your third, your fourth. Hopefully, it's your seventh roll, something like that. But if you get beat on that a little bit, that's okay. Remember, everything, your initial trade and all your rolls were productive to some degree before then. So you did well, and this is one way to sleep at night when you feel like things are reaching an extreme or near extremes. And with the rarities that have cropped up, and the extremes, right, that we have seen, I think you have to think about that at the very least. If you don't share my view, that's fine. But I think if you share a view or have a similar view, then I think that's the move to make. Just be really a disciplined player, because you are really getting there. And when we've seen these before, we are usually a little early. And notice we don't say fight the market, because we learned that the hard way. We say go with it. But we usually are a little early in these warnings. And then because we see things building, and then eventually, right over the next probably couple of weeks, those have usually been a pretty good sort of distant early warning, if you will. So on that note, I'm going to wrap up. I'm going to say that I appreciate everyone tuning in, sticking with us all the way till an hour in. But we are in a very exciting market with a ton of opportunity still. And it's been a great trader now for months and months and months. Last year was, I think, very good if you're willing to be a bull and a bear. But you just got to keep going with this thing. As long as they keep giving us the kind of movement that they have been, we really can't complain. There's just been so much opportunity. So we got to make this kind of money, these profits, while you can, because the market isn't always this chock full of opportunity, and it really, really has been. So on that note, I'm going to thank everyone for tuning in. I do hope that you got something out of this that can help you in this upcoming week of trading or some week in the future. And thanks for not falling asleep on me. I'll be doing sector situation very shortly. I want to wish everyone a great finish to their weekend and a great week ahead. Thank you.